Welcome back to the Atlanta Startup Podcast. My name is William Leonard, your host for today. I'm excited to be sitting down with Triet Nguyen, who is a senior associate at Render Capital. Triet, welcome to the podcast.
Hey, well, thanks for having me. And yeah, looking forward to this conversation.
Likewise, it's always a pleasure to sit down with another regionally focused investor who is taking advantage of being in one of the best regions in the country in terms of growth, capital, and diversity. So, maybe Triet, for those who aren't familiar with Render, maybe you can kick us off with an overview about the firm and really what excites you all.
Yeah, so a little bit about Render Capital. We're an emerging fund out of Louisville, Kentucky. We've been around since 2019, and how we got started was with a $15 million fund, and that one was a community fund. So instead of being very return driven, we were more economic driven, where we deploy capital through certain programs to invest in companies that are based in Louisville, Kentucky, or they're willing to relocate. Some of the programs are the Render competition, where we host every year. We invest $100,000 into 8 companies. Another program is a WeFunder match program, where at companies that are in Louisville, when they raise on WeFunder at certain tiers, we'll match their campaign. So for the first 20K, we match 20K. And when they get to 400K, we up our match to 100, 600, 200. And then our last program is called our First Dollar In program, primary focus on investing in Black and Brown founders. Luckily, we deployed all the capital in that program. So we invested in a bunch of founders in the area. But luckily for us and the founders in the region, we found partners to carry on deploying capital for Black and Brown founders. And then, for that one, like I mentioned, economic driven. So our LP really focused more on the number of jobs we created, the companies you invest in, how does that generate income tax for the state, especially the city. And then it wasn't until December of last year where we launched our more traditional VC fund, $15 million. This one, we're able to be a little bit more flexible. So early stage, pre-seed through Series A is our sweet spot. Industry agnostic, really letting markets let us know what areas to avoid. What does that mean? So like right now, we're avoiding anything that's highly regulated as well as hardware, just because interest rates, you don't know what's going to happen with political shifts right now for policies. But other than that, pretty industry agnostic. And like you mentioned, we are geography focused. So the Midwest and the South is where we like to invest. And how we really define that is really anywhere in the US outside of New York, Boston, and the Bay.
Nice. And you and I, Triet, we're talking about this a few weeks ago and earlier today, right? Just about like winning competitive deals and differentiation. I think with the emergence of so many VC firms that have come to the market now, capital has really become commoditized. And like we were saying earlier, to really succeed and win the competitive deals, founders are wanting that differentiating factor. And we've seen firms like Valor and Render and others really do this through platforms, right? Like we at Valor have Startup Runway, we've got the podcast, we've got VC Day, Render has WeFunder Match, First Dollar In, competition. Like, tell us more about some of the why behind these programs, and maybe you can talk about the importance of creating a platform as a VC firm and how it does help you get into those deals and win those deals.
Yeah, I think you touched on a very important point, right? Like having platforms, and for us running these programs give us access to founders very early. So a lot of the companies that are selected to, get funding from these platforms, they're in the angel, very early pre-seed stage. So it gives us access to trying to provide capital and help them even earlier. So that way, when they do get to the point where they have the VC metrics, we're top of mind. They give us a call when they're ready for VC capital, and that's where we invest out of our fund too. An example of that is one of our portfolio company, Xena Intelligence. They won the competition back in, I want to say 2021, and amazing growth. We moved them from Boston to Kentucky, saved a bunch of money on cost of living, and he ended up loving Kentucky and staying here because he loves fried chicken. And he said that was like one of the reasons why he actually stayed, along with the cost of living. But whenever they got ready to go do their seed round, they reached out to us, right? We gave them 100K very early on when it was just barely an MVP. Outside of that, I think we try to be differentiated, but at this point, there's so many reasons why founders pick VCs that first, our team is me, two partners. We're all either former operators or founders. So that's pretty attractive to founders, mainly that we've been in their shoes. We understand what they're going to some point. And then the other aspect of it, and I'll be honest here, we're a generalist fund. There's no way for us to help everyone and anyone that we want to invest in. So we try to keep that in mind. And during our conversation, as we talk with founders, we always ask them, hey, why us? Why are you picking Render Capital? Tell us, what is your ideal investor profile looks like for this round? And then that gives an idea of, can we truly help this company? Can we be a value add outside of capital? And, some companies, if they just want the capital, that's fine. That's great. I don't think it works for us, just because we're an emerging fund. There's three of us. That means that the people that you're talking to, we're not going to pass you off to another person or anything like that. So we want to have that relationship. And that's one of the reasons why I left my previous fund. Was we had about 40 people at the company, and it was very siloed. So where I was only doing just deal flow, I would have to hand off my companies to another department. And that's not really why I got into VC, right? I got into it because the relationship base. I want to be close with the founders that I bring in, because you get this. When we're sourcing in the early days, you're essentially selling not yourself, but the fund. And when you sell your reputation, your credibility, and all this stuff, you want to make sure you have that tie down the road to deliver. Or sometimes you might have to say, I'm sorry, I can't deliver on this. So yeah, and I think another thing that gives us an edge is that we have Render Capital, but we also have Render Innovation, which is our business consulting side.
Mm-hmm.
So they work with government organization, state, local, all over, as well as corporate companies. And that kind of gives us a good tie of a network, if you want to call it, of enterprise potential customers. It gives us on the investment side, like, oh, what are corporate companies running into? What is the biggest issues that governments are facing, for intros? And then, of course, I like to think we have a great investor network, such as Valor VC, that we can share deal flow with.
Yeah, I think it's so important, man. Like you hit on a lot of points there, but like going back to the platform side of the conversation, right? I think that will become table stakes here, as we've seen pretty much anyone raise capital in 2020, 2021. And now there's a constriction of capital from LPs and cutting back allocations. And, it's interesting to see. And I think as a fund, you need to be able to demonstrate to founders that you can support them outside of capital. So next round financings, helping them think about strategic partnerships. Brand building is one that I've seen a lot of founders talking about recently on LinkedIn, social media, just about building a brand and representing their LPs and their investors with the brand that they bring to the table, and attracting and retaining the best talent. And so it's so fascinating, Triet. And you also talked about sort of breaking into the industry a bit. I know you have a unique background, and I think our backgrounds are pretty similar in terms of just coming from non-traditional previous roles and understanding what it takes to break into VC. I get a lot of people reaching out to me And I think one misconception is that people don't understand how much of a sales job that being a VC is. Like honestly, it's just sales, right? You're selling your firm as a VC, you're selling your strategy to LPs, you're selling your value add to founders, you're selling your credibility to co-investors to come in on a deal with you or share deal flow with you as well. So it's heavily sales oriented, but maybe you can talk about your path and how you broke in to the industry.
Yeah, it's funny you touch on how VC is so much of a sales position because I actually used to be in a sales program in college and I was just a terrible sales student. And my professor said, "Hey, maybe sales isn't an industry for you because I don't think you'll make it." But then here we are. But yeah, I'm more than happy to share a little bit of background. So I came out of college wanting to do events. Like I just wanted to throw a music festival, do events. Ended up, and honestly, it was very fortunate that I got an internship at the Dallas Entrepreneur Center, where they helped founders go from idea to their first fundraise. And that was really where I kind of fell in love with startups. From there, got an opportunity to transfer over to Capital Factory, which is an accelerator fund down in Texas, most active investor in Texas. And that was really where I fell in love with VC. Luckily for me, though, at the time, they had just launched a location in Dallas, just because their headquarters in Austin. And, one of the things that I always heard from mentors and you hear it on social everywhere is that if you're just coming out of college, go and you land a job somewhere, try to network with other people outside of your department, take on projects, especially if you're at a startup that are not in your department. So that's what I did. Volunteered to, help out the marketing team, the partnership team. And I was interested in what venture capital was. I didn't know what it was. And I approached the venture associate at the time and I was like, "Hey, I have about 10% on my plate that I would love to allocate to you because I'm interested in learning about this stuff. Whatever you want me to do, just let me know. I can take notes, do the boring stuff, whatever it is." She said, "That's amazing. You do events. Dallas is a big city. I can't go to multiple events at the same time." So what we did was, I guess, sort of like a scout program. Anytime I meet a founder that I thought was interesting, I would bring them to her and we would meet for lunch or coffee every Friday, kind of going over the companies I thought was interesting. And she would kind of like talk me through it. And it's like, "Oh, why did you think this was interesting?" If I didn't have a company, then we'll talk about markets. And then during that course of time, the companies I brought to her ended up going to the accelerator fund. And she was like, "Hey, you have a knack for this. If you want to break into VC, let's talk about that and try to figure it out." So the first step was network with all the mentors at the accelerator fund. I took office hours with a lot of them asking for advice. Most of them mentioned you need to go get an MBA, go work at consulting, investment banking. I couldn't do any of that. Or go get operation experience. I was like, "Okay, I can do that." And all that means is I started my own company during COVID. It was a CPG company. I started with my roommate. Essentially, we did on-demand charcuterie board delivery in North Texas, taking everything I learned from the tech industry, applying it to a catering business. And that's how we beat out our competitors, which just automation to provide convenience. Instead of ordering 2 days in advance, it's give us an hour and 15 minutes and we can bring it aboard to your door. And I think you kind of touch on this earlier as like nowadays we have a lot of people reaching out to us about like, "Oh, how do you break into VC?" And from LinkedIn, it seems like it just happened overnight. And even sometimes when we speak on panels or like podcasts, it sounds like it just happened overnight, but it didn't. It started my journey starting to like, I want to break into VC. And when I actually did break into VC, it took me about 3 years. So going through all that process, having that apprenticeship from her, along with other VCs in the industry that was 1 to 3 years in front of me, so I can have more actionable plans to break into VC. So I was starting a company, just get the founder experience, learning what that's like. Started angel investing. I guess total so far, I've made about 4 angel investment, learn a lot through that process, been through 2 different venture scout programs, volunteer my weekends, holidays working for startups, like not even like getting paid, just volunteering, like, hey, do you need me to build you a better inventory database? Sure, I'll take that. But you don't have to pay me, give me equity, let me be an advisor. And kind of going through reading tons of different books on VC, taking a bunch of courses, all that good stuff. And
Yeah.
then the opportunity kind of just come. And I wouldn't say I didn't break into VC until like this year at Render Capital, just because last year it was just deal flow, which is mainly just sales. So it wasn't too much VC. So yeah.
Yeah, I think one of the underlying themes that you hit on in that anecdote is networking, right? And that's what I tell people who always reach out. It's like network, meet with analysts, principals, associates, partners, if you can get access to them and understand their thesis, what they're looking at in the market right now, and send deal flow with no expectation in return. Just like send them deals, but make sure that it's aligned to their thesis. Because I tell people all the time, it's no worse feeling than someone sending you a deal that's 1,000 miles from your thesis. It's so off. And so I tell people that, and like stay up to date on the industry. So as you're going through interviews and conversing with people in the industry, you can actually talk and sort of speak the language. So like I was telling somebody the other day, like read 3 articles a day, right? Like go on TechCrunch, Wall Street Journal, read something that's relative to the macro economy, read something that's relative to a financing or a deal or an M&A in the particular verticals that maybe you're fascinated in, and then read an article about a particular company or an industry so that you can sort of build some expertise and deeper knowledge around that. And I think, like you said, you do those things, you send people deal flow, you immerse yourself in the industry, you do things with no expectation in return, opportunities will just start to gravitate towards you. And I think you kind of create your own luck by doing that and putting that work in on the front end. So that's good advice. And one thing that you talked about, Triet, was networking and community. And one thing that Render has done really well is really get involved with the community, especially the founder community. I want you to talk about the founder toolkit that you all have built and sort of open sourced a bit, and tell us more about what that is and how it's supporting founders at the earlier stage.
Yeah, it's interesting you bring that up, because like I would say that definitely helped me stood out to Render Capital when I was going through the interviewing process. Because when I was trying to break in, I was essentially obsessed with VC, and I essentially bookmark every resource about startup, fundraising, investor database I could find on almost any platform. And then I was like, you know what? For some reason, I can't break into VC. So let me focus on showing my value to serve a VC's customers, which is founders. So I built a founder toolkit, and all of it was just broken into 2 different boxes: fundraising resources, where I linked and of course credited all the information from what does a cap table needs to look like, what is a due diligence checklist should like in a data room looks like for a founder in the first, when an investor, I was like, hey, send me your data rooms, like what's in it. And then I think we made like curated investor databases where it's broken out. Right now, we have about 15 curated investor databases in an investor database. So depending on the industry, where you're at, stage you're at, there's a list of funds that is a potential fit for you. And whenever I was interviewing Render Capital, that was something that they asked, like, what value are going to bring to the fund that we can't do ourselves? And I was like, okay, well, there's only 2 of you guys. You guys don't have a portfolio service platform. This is the toolkit I built. This not can only generate deal flow for us, but also helps founders as well. So like that's kind of tied back to our differentiator. Like now when we, elaborated, built more to it on the founder toolkit, it talks about our thesis. It gives a ton of resource on fundraising as well as investor databases. And for us, that's trying to show that, look, all ship rise with the tide. So even though we aren't investing in you, we want to be able to point you in the right direction so that you're closer to a yes on your next call. And doing so, I think that helps our social capital. But end of the day, we were former founders and operators. We know what it was like to hear no with you're just too early. I was like, what does that mean? And it's like, oh, you're too early. Check out funds somewhere else. Like, do you know them? What are their names? Because most funds don't really tell you what exactly they're looking for, or like their thesis is a very broad thesis.
Mhm.
So that was like very difficult. So we made that. It's a big hit with founders. That's something that we always give to founders, and our partners also make it a very, I guess, key point, and then like they ingrained to me that yes, sometimes it's difficult to tell a founder why you're saying no, but we need to do that. Even if it's just short bullets, that differentiate us out, and that makes us very respected by founders. Instead of, I know a lot of funds try to be founder friendly, we try to be founder respected.
Yeah, I agree with that point, right? Because, and this is something that I learned over my time of being in the industry. I used to be afraid to tell people why we're passing. And I think there is a respectful way that you do have to go about passing. But as you mature throughout the industry, you realize that founders want the real. Like they really want to know why you're passing and what they can do to improve their chances with the next conversation with the next investor. And I found that founders really respect that over a general, oh, this is too early for us right now. Come back in 6 months, or, we're passing for some very generalized, broad reason. I think actually articulating in a true and concise fashion on why you're passing and what makes this opportunity out of scope for you all really does create rapport and relationship with the founder, because they're going to respect that. They're going to respect somebody who's not BSing them and actually telling them the truth. So I can resonate with that point as well.
Yeah, it wasn't until the more I did it, the more response I got where founders were like, "Hey, I understand, and I just want to say, really appreciate you for being transparent with me. You'd be surprised how many funds just doesn't reply in general, or just say, hey, you're too early." Um, and honestly, sometimes I just tell them straight up where you are too early for us to take this risk, and that they understand that, like they understand, like, okay, so it's not just like you were too early because there's a magic number we have to hit. Is from a risk profile, they understood that's why, and what we mean when when we're saying they're too early. So yeah.
Yeah. And some of the best relationships are built like that, where you're bullish on the founder, maybe bullish on the industry, but the company or product maturity just isn't aligned with your core thesis. And you build relationship over 3, 6, 9, 12 months, and you come back, you check in over time, and who knows, a deal might get done. But I think, like you said, building that relationship, being transparent, establishing that vulnerability is really important. And as you all are thinking about the market right now, right? You're focused on pre-seed through Series A. You're really intentional about letting the market dictate your strategy. How are you all thinking about pre-seed and seed and Series A deals right now in the market, given where we are from a macro economic perspective?
Yeah, I think it's going to depend on a lot of different variables. So I'll try not to be too broad to answer this question. So where we're thinking about right now is that first, Series A, yes, we'll invest in Series A, but for our strategy as an emerging fund, that's primary focus for follow-on investment, really. So I would say a company would have less than 1% for us to just be open to doing their Series A, unless it's like crazy traction, very low evaluation, and it's just an absolute crazy deal, which you're not going to see. But when we talked about pre-seed and seed, what we've noticed that there's quite a lot of other funds that are either shifting their focus or they're raising their next fund and they're shifting later stage. At least here in the Midwest, that's what I've noticed is like they're going later stage. There's a lot of reasons why that is, but that primes the market for us to say, hey, if everyone's going later stage and we know them already, at least we know the person to send our companies to. So let's stay here. Let's walk down the path that is not being walked down by a lot of folks. And at the end of the day, it's like kind of going back to like the mission statement that we have on our website. It's like we envision a world where there's more opportunities than there are obstacles, right? And part of that is you just got to stay investing in early stage. And as far as how markets are going, I think in the Midwest and the South, I mean, you'll probably see it, is that valuation has always been lower than on the coast. Founders have been more realistic about their traction to their valuation multiple, all that good stuff. So we don't see too much of an influx. Yes, it is lower than, I guess, previous years, but it's not that much lower, right? And with this thesis, where if we had this conversation 6-8 months ago, our average check size then was about 250 to 500,000 on initial investment. But now we completely changed it where, and shout out to our LP for helping us come to this conclusion, was that we want to take larger swings. We realize our deal flow, our network is providing such great opportunities. And now we're being more active on the deals of, okay, we don't even want to write 200K checks or like 250. It's like, if we want to invest in a company, we want to come at it with the conviction of writing $500,000 check and ask for board observer seats or at least a board seat, at least just for this next round, so that we can be a little bit more involved to make sure that we have that conviction of the companies that we're selecting in. Does that mean that we're doing less deal flow? Yes, but we're writing bigger checks. And I think, I forgot what fund it was, but there's a VC fund out of Atlanta. They released it that pretty much state of VC in the Southeast where
Panoramic.
yeah, less deals being done, but bigger check size. And I think that's starting to ripple effect across the Midwest and the South, just because we don't have the amount of capital and funding from LPs like the coast. So to make the return profile worth it is to take larger swings, be more active, but less swings.
Yep. That's a really interesting assessment there, right? And yeah, shout out to Panoramic for putting out that State of the Startups report recently. And no, I think that's, you mentioned, right? Smaller checks, more deals, or larger checks, fewer deals. I think that's an inflection point a few firms have come to recently, just given where the market is today. And you have to have some sort of agility and nimbleness in your thesis and strategy as the market begins to really shape how capital is going to be allocated here over the next 6, 12, 18 months. Who knows how long we're going to be in this inflationary environment. So it's really interesting. But Triet, how can founders listening to the conversation today get in touch with you or someone on the Render Capital team?
Yeah. So if you want to, send your pitch deck and all that good stuff, obviously render.capital. We have a button where submit your deck. You can kind of go through the form there, and it kind of lets you know, like, based on where you're at for both geography, stage wise, which fund is the best fit for you. Also, you can find me Triet, Triet, at render.capital. That's my email. Pretty quick to respond sometimes, depending on the season. But I will respond. Might not be with the answer you want, but I will respond.